Okay, we should be live here. Hello, everyone. And first of all, I'd like to thank all the guests for coming on. I think this is the most I've ever had on a live stream, 4 guests. And today, the title of the live stream is Central Bankers Preparing for a Major Bond Market Crisis. And yeah, but before I go into this story, which came out late last week in the FT, I want to introduce everyone. First of all, Andrei Jakubovic. He's in Brazil. He's a former investment banker in New York and in Brazil. You can reach him on LinkedIn if you want to connect with him. Clive Thompson. He's in Geneva, Switzerland. He's
silent.
Wealth manager, and he's on LinkedIn as well. He's in Geneva, Switzerland. Of course, many of you know Clive and Rafi Faber. You can find his work at Rafi Faber or the Endgame Investor on YouTube. He's also on Seeking Alpha, and Francis Hunt, the market sniper. He's in South Africa, so we've got a really good geographical mix. You can find the Market Sniper on YouTube as well. I highly recommend that. So, guys, welcome and thanks for coming on the live stream.
Thanks for having me.
Mario. Glad to be here.
Great.
And good evening, Mario.
Good evening. So I'm going to start with this. Hold on. I'm going to start with this article that I saw, and I thought it was quite important. Because I don't know if you guys heard of a guy called Lindsay Williams. You might not have. He's an old American guy. I'm not sure if he's alive, but he worked for the he was a chaplain, so he's a religious guy. He worked for the major oil companies in Alaska, and he met what he called the elites. He met a lot of important people, and he said one thing they do is they always tell you, even though they're doing things not to help the general public, they always warn people of what they're going to do. And unfortunately, we have too many distractions, and very few people, read between the lines. So I saw this. This is from November 10th. And it says Bank of England to model major bond market shock. Central banks exercise aimed at understanding how severe stress scenario could affect financial sector. And I know it might sound a bit conspiratorial, but I remember, well, it was after the fact, but in 2019, in October, they had Event 201, and they were doing exercises as well. In case there was going to be a huge pandemic. And lo and behold, a few months later, we had the pandemic. And so you guys probably read the article. I sent them to you. I've got here pretty much the, how can I say, summary of what it says. But they asked the 53 major institutions to participate in this. And they only named in the article Barclays, JP Morgan, PIMCO, Goldman Sachs, Aviva, and Man Group. And basically, they're preparing for a major bond market crisis. And if you read the article, they say that there will be, they're kind of blaming geopolitical crisis. That's what they're saying, that a geopolitical crisis will lead to a bond market crisis. Of course, I think that's just a cover, but they have various scenarios as well. And they call this the system-wide exploratory scenario, SWES. So they do like their acronyms. That will probably, right now, very few people know about this SWES, but I bet you it's going to be something big next year because I think that, just looking at how much debt there is and the technicals and the macro, I can't see the bond market going any other way. So with that, I'll ask Francis to go first, as he was the last one I was able to contact today, and it was good of him to come on. So Francis, what's your view on this? Do you think this is just something that's not going to happen, and they're doing this for just to as prevention, just to tell people, oh, we've done this, or are they trying to tell us something?
Oh, they're absolutely, well, they're potentially trying to tell us something, but it's a very, very plausible scenario cast of the future, the near-term future, closer than many people realize, to an actuality. A couple of people, debt markets are a bit mercurial for the average retail trader, and I just want to highlight that a couple of minor basics. It's like a seesaw with a fulcrum, and valuations down, interest rates go up on the other side. So you need to think of this relationship. And what we're actually seeing, many people say, well, the Fed, because the economy is so bad, the Fed won't hike rates or anything like that before. And we've actually had a microcosm of this with the British pound collapse with Soros. It's actually taken out of central bankers' hands the markets devalue debt, because we actually have an excess supply of debt coming with an ever greater expectation of an exponential further supply, plus the interest rates, which is money we don't have that we have to borrow into existence, creating, of course, new debt because money is borrowed into existence. So what we're actually going is we're hitting the parabolic phase now that we've done these very, very brisk rate hikes after loading up on debt to probably our maximum when the rates were super low. So we're hitting that point where you're going to get excess supply, and you're getting it in an environment that the retail guy is actually quite wrecked. So it's not going to be about the economy rates. It's going to be all about debt devaluation. That's how you have to view it. The excess supply is debt devaluation. In the events of March 2020, which was COVID, we got a zero oil price. That's not because the input costs to get oil is zero. It's because we had an orchestrated glut and a dearth of demand. And what ends up happening is you have a market, a very abrupt and violent market reaction. And what you've just described in articles is what we've been saying for 2.5 years, Mario, that our theory, kind of like Brent Johnson's milkshake theory, is an interest rate super spike theory, which is based on an extreme devaluation event, absence and bid. And as they referenced, Liz Truss and the British already had that on the pensions. There was no bid. They didn't have sufficient funds on their pensions, which was also a sidebar comment on the sustainability of pensions, which is where most of this debt resides. But on top of that, you had an absence of bid almost entirely on that market. And we have turned, the chart you're showing makes the point very beautifully, is we've absolutely turned in a 40-year bull market, and we loaded up all the way down. So that's to answer the short form answer, I suppose, and to bring my point to an end, is absolutely this is an eventuality I expect to have happen in various forms. We've already had microcosms thereof in the Treasury recently, and in the UK when they threw the Prime Minister and the Finance Minister under the bus. But in actual fact, it was the Bank of England that had not matched America's rate of increase in the interest rates. And as a result, there was an arbitrage. People sold gilts to rather hold treasuries. The pound got sold off. And then when pension funds needed to sell off, there was no action on the buy side. And we've also had microcosms in the Soros event, but that was just one nation state. What we now have is a global coordinated leper colony where everyone's kissed the leper to get in, and they're all in that state. And we're going to have synchronized rolling events like this across all major nations potentially. And we've already referring to two. We have the Japanese scenario as well, where there's been absence of bid reported. So unfortunately, in my opinion, it's a very real actuality that is not far away, and it falls into our model of the hyperstagflation.
Great. And yeah, you mentioned Soros and the Bank of England. I remember I just arrived to work here in London in 1992. I started in the beginning of September, and then one day the pound just collapses, and the Bank of England raised rates from 10 to 15, and then they cut it back to 10 the same day. So yeah, a lot of people think that when there's a next crisis that the Fed will be able to cut rates, but what you're saying is that they won't. So Rafi, with that, we're going to go to you and maybe get your opinion on the bond market, and maybe talk a little bit about the reverse repo, which you've been following quite closely.
Well, yeah, what Francis was saying is that we have to keep having more and more and more debt. That's the nature of all fiat systems. So if you just scale back a little bit and think about it logically. If you issue more debt and then more people take on that debt, then more people owe more money. And therefore, you need more money to be brought into existence to pay back that debt, which is more debt to bring more money into existence, because money is the other side of debt these days in a fiat system. And so it must keep going exponentially higher and higher. And right now, we're in a point where we're stepping off that curve. The money supply is falling, interest rates are rising, meaning the debt is falling in value, and then at some point we're going to hit a wall. When we hit the wall, the central banks are going to go print vertically again. So I don't even know what the point of them in modeling this is. What do they think? Like, okay, so if you model, let's say, a nuclear catastrophe in some city, then okay, well, so it's going to be gone, and then we're gonna, like, how's modeling going to help you? Okay, so
Yeah,
so they can model it, and then they can say, well, it's going to be really bad, folks, and we'll be like, yep, it's going to be bad. Well, what are we going to do? Well, I don't
even
know.
even the scenarios they have, is their scenarios that a major crisis would be a 75 basis point increase in treasuries in 3 days. I guess that's pretty bad, but I think
It's
it
going
would
to be
be,
much worse than that.
yeah, yeah.
I mean, what I'm seeing is, like, if eventually they're going to run out of they're going to run out of liquidity to fund primary treasury auctions or primary gilt auctions, or all these countries are now putting the brakes on their money supply, which means they're going to hit a wall at some point where they run out of liquidity, and then an auction is going to go bad. And then, let's say if the Fed not the Fed, if the Treasury wants to raise $100 million in 10-year notes one day, and then they only get bids on like 70 or 80 million of it, and then the bid to cover goes below one, then you could really have a serious panic where everybody sells bonds at the same time, and forget about 75 basis points, talk about 500, 600 basis points in a day. That's what's going to happen. And then all central banks are going to respond with coordinated action all over the planet to print a whole bunch of money and buy a whole bunch of debt with it. And they'll calm down the bond markets, but all the fiat currencies will be dead, within a matter of days or weeks. That's how I'm seeing it. Maybe I'm exaggerating. Maybe I'm being doomsday. I don't know, but I don't see any other way. I mean, this can't go on the way it's been going on since 1970, 1980, 1990. Things are getting way too out of control all over the place, and wars are erupting everywhere, and humanity is being disturbed, and this has to end. It has to end quickly, and that's how all of these things end. They end quickly.
Yeah, and so now we'll skip over to Andre in Sao Paulo. And so how do you see this? And after we go over each of your guys' opinions, I want to talk about whether this could be averted and we could have another bull market. But first of all, let's see what you guys think about a bond market crisis. Over to you, Andre.
Well, I would like to segregate the base layer, US dollar bond markets, US bond markets, as the base layer for the entire fiat currency system. Because it's important, because although every single currency, they will end up with the same fate, the dollar is the last one standing. That's where resides the yen, the GBP, the euro, all the major currencies. So when you start looking at what's going on outside the dollar, you might wonder, when they model these things, that they might have to resort to a great number of uh, initiatives in order to soften the blow, or maybe push the can further down the road. And that's when I think, when they model these things, uh, everything is on the table. CBDCs, where your money gets locked in, your spending is programmable. And what that might allow them to do is to print enough money to save the bond market and avoid inflation by seizing money velocity, by resorting to programmable CBDCs. that has a problem because, there might be a lot of civil unrest. We've seen what happened in Nigeria when they tried to launch that. But I think they're not too worried about this. But here's a problem. And before I get to the base layer, which is the US Treasury bond market, the problem, if you think about especially Japan and Western Europe, is that they need to have currency to pay for food, energy, and hard commodities. And what's going on with the BRICS Plus, where, call it what you will, I mean, I would avoid thinking about, power games. Let's just be simple about it. Why would you sell oil for worthless currency? So it's not sustainable. You're going to sell your oil with dollars that are worthless or are mathematically worthless as we see it today. So I'm not going to go out on global domination, US dollar as a reserve currency status. I mean, they printed way too much money, and this cat is not coming back inside the bag, because unless they decide to tax the heck out of citizens and end up cut off entitlements, this thing is beyond being fixed. So the problem in Europe is that even though they might want to resort to severe financial repression, ditto for Japan, how are they going to pay for oil? How are they going to pay for food and other commodities? So here's the big deal. I mean, we already seeing gold moving from the West to China. There's an arbitrage. China continues to buy gold. They're putting together some trade systems amongst them, so to avoid exposure to worthless fiat. And having said that, going back to the United States, I've done some thinking, because people think it's like business as usual. I mean, you print the money, you save the bond market, and if need be, you start doing a Japan style yield curve control in the United States. I mean, you cannot do that, not in the base layer of all fiat currencies. The minute you start resorting to yield curve control in the US Treasury bond market, I don't know what's going to happen, but I fear all hell is going to break loose.
Okay.
So it's very hard to, say what's going to happen, but we know it's coming. I'll leave it at that for the time being.
Okay. So Clive, to you now, and last but not least.
I'll come back to some of the things that Andrew said in a minute, but the first thing was what are they planning under the system-wide exploratory scenario that the Bank of England has asked the financial institutions to look into and model. They're envisaging some very, very specific numbers. Specifically, they say, we want you to assume a 115 basis point rise in gilt yields, 130 basis points rise in investment grade borrowing costs, and 75 basis points rise in US Treasuries. And they go on to say that this scenario is plausible. So it's a plausible scenario. And they also say what the cause will be. They say the cause will be a sudden crystallization of geopolitical tensions. Now, they've given the participants up until the end of January to reply. That's like nearly 3 months to reply. I don't see why it takes long to reply. And then the Bank of England says, after they've replied in January, they'll produce a report by the end of 2024, which I'm wondering if that's long enough for them. But anyway, that's when they say they're going to come out with a report. I can't help feeling that this is a little bit closing the stable door after the horse has bolted, because we had this crisis back in September 2022. You may remember from in less than a month, interest rates went up by more than 250 basis points. They went from less than 2% at the end of August to at the end of September for over 4.5% for a couple of days, which was a rise of well over 250 basis points. Therefore, a much bigger interest rate spike than they're asking the banks to now model. So what the scenario, of course, they say it's a plausible scenario, and I wonder if they know what's coming, but it certainly seemed plausible to me, given that they had such a spike. I'm kind of wondering if they put Liz Truss on the committee to do this, because she's got some experience in the matter, I believe. That will be interesting to see. Now, coming on to what Andre is talking about, which is how this, now we move over a little bit more to the United States, how all this palaver with interest rates spiraling out of control and how it all comes to an end. I happened to find today something on a US, I guess it's a US government website, which I thought was quite interesting, which spelled out another way in which it might come to an end. This is from the National Bureau of Economic Research, and it's from a paper they wrote called Maintaining Central Bank Financial Stability Under New Style Central Banking. And it's quite a long paper about central banks and what happens if they run out of money or things go, they're losing money. But I get to page 15, I found this, which I thought was quite interesting. It says, they talk about the central banks becoming insolvent. They say, theoretically, this implies a hyperinflation, literally money supply equals infinity, because reserves become worthless. But in practice, it comes with a currency reform, such that the old central bank effectively closes its doors and a new central bank with new liabilities starts over. I thought that's very prescient, because we've been talking about a currency reset for quite some time, but there's another way in which it might happen coming out of the National Bureau of Economic Research. So we'll see. That's just a new thought. It's maybe an old thought that they wrote some time ago about how this might all end.
And that's interesting. And so I read this article on the 10th. So that was Friday morning. And then Friday evening, I went out with my wife and we went for a few drinks with a friend. And then I get a WhatsApp message from an old friend of mine who I haven't seen in years, but I keep in touch with him. And it's a picture of him with Christine Lagarde. And he said, oh, you should have her on your channel. And I said, well, if she wants to talk about why we should abolish central banks and fiat currency, then she's welcome. And then I noticed that they were in the Royal Exchange, which is the old stock exchange in London, which is now just like a shopping place with restaurants. And it's right next to the Bank of England. So I wonder if, and he said it was on Friday that he bumped into her. He doesn't know her, but he just took a selfie with her. And I found it interesting that she's right next to the Bank of England. I wonder if she was meeting Andrew Bailey about this new SWES. But we've got a question here from Norway. Gur Olgi. And thank you for the super chat, Gur. He says, if the central banks didn't buy tons and tons of gold every month, gold will have to be way under $1,000 an ounce. Or is it just a scam? Something is wrong. So I'm not really sure what he means by that.
I've got a comment, Mario, on gold generally, which might cover his general question. Central banks have been acquiring at a rapid rate, and China has been acquiring at a rapid rate. And similarly, China has also been divesting from treasuries. So just tying a couple of dots here, we've actually had a very dicey treasury issuance that I was referring to. There's a Zero Hedge article for that. And I've just given another Zero Hedge article to you in the links that highlights that we now have a proof that New York gold is being transferred to China in that narrative story. And there was a period where I put forward, I suppose, speculative theories, because given the likelihood of the debt markets collapsing, I always asked, why was China holding its 1 trillion? Well, recently they've been divesting, and I think they're at about 800 billion now. And amazingly, Japan and the UK have stepped up, which are very much part of their axis with the Fed. If you watched our interview with Professor Werner, he'll tell you that post-World War II, essentially the Bank of Japan has been dictated to by the Federal Reserve, and of course the Anglo-Saxon link being what it is. But the interesting theory that I postulated came out of the fact that gold markets always traded down on the London, New York, and always traded up. It's almost a sure thing. If you plot the two charts for gold, one is an absolute parabola on the Eastern market, and the other, if you just traded, if you went long the open on the London into the New York close, it's actually a crashing line. And the actual gold price is the combination of the two, which is broadly up, but not as up as much as some would like, as I think your questioner is asking. Why is it not higher? And have the central banks kept it on? So as part and parcel of all of this, currencies. So we're going to have interest rate spikes potentially, and also we're going to have chronic devaluation of debt markets. So where does everybody who starts to realize that run to? And gold is one of those things for central banks, because they don't want to run into other currencies, because they're going to run into the same problem. They recognize everybody's a leper in the leper colony. So in essence, the gold is clearly a big thing. And we postulated that by not disorderly dumping their trillion, China was getting the benefit of a discount window effectively in the gold market, and has been net accumulating on the Asian session, and the market price has been sold off during the American session, off of largely derivative-based contracts. So as long as that non-dumping on the one side, it's kind of like we're in a battle, Mario, and we're both in the water and we're enemies, but at the same time we both could drown, so we need each other to cooperate. You've got your hand on my head to duck me, and I've got mine on yours. And in essence, the deal is don't push too hard right now on me, and I'll not push too hard on you. And one hand, it represents the selling force of treasuries, and the other one is you cutting some slack potentially on the gold price for me to acquire an asset that's more desirable, physically held and under my control, and potentially leverageable. So bringing in the metals into this, currencies are going to get exceedingly volatile as part of the debt devaluations. So all these things are going to suddenly go into volatility. And I would anticipate manufactured geopolitical events, which we might already be seeing some thereof, will be part of more a distraction element than the actual cause. They will say, who could have guessed XYZ would have happened? No, this is a debt collapse. It's been coming for a long, long time, and it is baked in, but they will give you, like Greenspan said, a black swan. Subprime was a black swan. It wasn't. It was predictable. It was a malfeasance, and it got worse. In the same way I'm expecting, looking forward. So those are my speculations. And in actual fact, gold will do rather well, is my anticipation, under the ruse of almost all treasuries of all nations being dumped for gold, and a sudden rush for gold, which will probably coincide with the spike in rates, and the spike loss of value in debt will be a spike bid for metals. So everybody, the minute people don't sell a house, even if they think it's the wrong house, until they know what they want to do with the money. When everyone realizes what they want to do with it at the same time, they're rushing out of one thing into the other. So that's why I think we'll get those spikes. And can I also, just to complete my case for gold, highlight that the March 2020 events technically, so visualize the chart, you had the huge spill in rates, which was a massive blow off, which is typically how all 40-year cycles would end, a macro 40-year cycle. In fact, the dot-com was much shorter than that, and you know how that blew off. And you also, simultaneous to that, just to show the inverse relationship with bonds, that is a yield instrument, and gold, which is a capital preservation instrument, you had a blow-off in the gold-silver ratio, which went right the way up to 126, coincident with that rates collapse and the spike valuation in gold. That was a trend change event. This is a macro trend. And the other key point I want to make about that 40-year bull market is, you take a very flat escalator up for 40 years, you do not get the luxury of a very flat downside escalator. You go straight into the elevator, and the cable gets cut. This is over in 4, and it is part of the reset in my view. So let me just hand that back, the talking stick, to everyone else.
All right. So there's a question here. Maybe Rafi will want to answer this one. From Chris Conman, and thank you for your super chat, Chris. What will happen at a future bond market auction that goes no bid? What psyche will that have on the financial markets? and gold and silver. Thanks. So I'll let Rafi answer that, and maybe also Andre and Clive if they've got something to say on that.
I don't know. I think that's the end. Once that happens, once a treasury auction goes no bid, everyone's going to panic at the same time. Central banks will buy gold, people will buy gold and silver. I mean, that is the concretization of what a financial crisis is. Like, the purest form of financial crisis is when all of the derivatives die at the same time and everyone just goes after the gold directly, or if in the absence of gold, they go after anything else that has actual tangible value, like bread or,
And the other thing is
whatever.
No bid. I think it could get worse, even if you get like what they call a bid to cover of less than one, which means, if the Treasury issues 10 billion and they only get like 9 billion in bids, that's really bad as well. But no bid, that's Armageddon, really Armageddon. If nobody shows up for the auction, not sure it will get to that. But what's your view, Andre, on that one?
Never going to happen. Never going to happen. They will print the money, buy these bonds, and then inflation is going to run loose.
Yeah.
They're going to try to stop money velocity by gating people in to their bank accounts, CBDCs, all sorts of mechanisms that they can utilize to minimize the damage. But it's going to come at a price. People, you see what people did in Lebanon, what they did in Argentina. I mean, it's going to play out somewhat similar to a certain extent. People are going to get debased in a big way. I do believe, I agree with Rafi, hard assets are going to fly. I'd say oil, gold, silver, natural gas, everything that is, including bread, is going to go through the roof. And it's not going to be the case where there are no bidders. There's going to be the case where the Treasury, the central bank will have to step in. But then everybody's going to see that, the king currency is finally caved. Huh?
Yeah.
It's hard to predict how these things
I even think right now, sorry to interrupt you, I even think that right now the Treasury is probably intervening, and you might ask, if the Treasury is issuing bonds, how can they buy their own bonds? Well, they could do it through the Exchange Stabilization Fund, which is probably the biggest hedge fund in the world. So they'll use that as well.
Yeah, to Rafi's point, they tried to sell some 30-year bonds, and you saw what happened. It didn't work out well. I was guessing they were trying to flatten the curve. They thought they had the long end under control. They were going to issue T-bills, use up the reverse repo balances. And then all of a sudden they got too greedy, decided to auction some 30-year bonds, and it was a disaster. And to boot, after hours, Moody's downgraded, gave a negative negative outlook for U.S. credit standing. So we might start getting a little bit of an appetizer as markets open this Monday. I'm not holding my breath. I think people are going to just hum along. But what we saw last this auction, it's a little bit of what's about to come, in my opinion.
If I can just make mention of something, Mario, sorry, jumping maybe my turn, but I assess from technicals that there is already government intervention in the market. So they are already a dominant active participant. And I've seen this in the British bond markets
everywhere.
And I expect it's everywhere as well. I mean, we called the euro Swiss franc currency collapse, and we saw the exact same price behavior. And this is central banker intervention before they even said, one of these days we might intervene, trying to hide the fact that they already panic, trying to plug holes. And we've seen it already as we reached yield highs on a number of the British debt instruments, the exact same price behavior, spinning tops, logical round numbers, really contained, excessively low vol, clearly tapping up against the ceiling, and a continual provision of liquidity to cap it out there. So I'd make that comment. It's already happening.
I agree with you.
So the reason they're drilling for this eventuality and making it such a conservative scenario is because they know that it's already part the way on its way, and they're already actively doing what they have to do. So they're practicing putting out fires that they know are already started.
Clive, so your view on the bond auctions?
Well, I'm pretty much on the same page as everybody else. If the Treasury auction goes to no bid, or if we just simply see a generalized collapse in bond prices, which means a rise in yields, I think the central bank, which is supposed to be independent, will be told in no uncertain terms what it's supposed to do. And that basically means it'll be told, you buy those bonds, and the only place you can buy, only thing you can use to buy those bonds with will be by printing money. So I think what will happen if we get into a dangerous situation with the bond market, the central banks will step in and start buying bonds by printing money. Now, that means that they've changed strategy from the present strategy of quantitative tightening, which means they're not expanding the balance sheet, into a quantitative easing, which means they are expanding the balance sheet. On the day that happens, the whole world will know that it's happened at the speed of light. And what that basically means is we move from a tightening scenario, which is what they're purporting to have at the moment, into an easing scenario, which is very inflationary. And we're going to see an expectation that inflation and asset prices will move higher. So I think on the day that that happens, we will probably see a melt up in asset prices, which I think Rafi and Andre all agree with. And when I say melt up in asset prices, I mean the first things to move will be the kinds of things which can move, like equities, gold, silver, and I think bond prices will rally as well, because if the central bank is stepping in as buyer of the last resort, you now have no risk if you own a bond. At least that'll be the way it'll be perceived on that day. So yeah, I look forward to the day it happens, because I think everybody owns any assets, any tangible assets, will be delighted, because their assets will be going up in price that day.
Yeah, Francis was talking about the Bank of England manipulation, and I agree with him. You can see they're just trying to stop it. This is the 20-year gilt yield, stop it from going above 5%. And the thing is, I've noticed that I watch the yields in the U.S. Treasuries and gilts every day, and the 2-year gilt yield got up above 5%, but now it's back below. And despite that, we have CPI at almost 7% and the Bank of England rate at 5%, and they're trying to tell us that the 2 years should be below 5%. Is just crazy. So yeah, a lot of manipulation. Now I wanted to talk a little bit about what all of this means to the real world, because I'm sure some of the viewers are probably asking, how is that important? So I wanted to first start with an anecdotal story. I met this friend of mine. I've known him for about 3 years, like this Friday, and we went for a few beers, and he's 64, and he said, I've been putting so much into my pension. He had a company, and he started putting something to a pension. And he said, I put 60,000 in over the last 15 years, pounds. And he said, but now it's worth 38,000. And I said to him, well, that's because bond prices have dropped. And what they do here in the UK with pensions is that once you turn maybe 60 or 61, they put a lot of your stocks and other investments into bonds because they're supposed to be safe. And so yeah, and I read the other day as well that the BBC has a 1.8 billion pound shortfall in pensions because they index the defined benefits to inflation, so they're having to pay people who are retired even more. So I'll start with Rafi. Rafi, how important are these asset prices to pensions, especially, and how do you think that's going to impact I think it's going to be disastrous, especially that we've got the baby boomers retiring, and they're retiring right now.
Oh, funny you asked that question. I have on my screen open right now the latest statistics from SIFMA, and I'm looking at the holders tab. So of the outs,
share that if you want, Rafi.
I can share it.
Yeah.
Okay, let's see. Let's see. Share screen. Here it is. Here's the latest SIFMA statistics. I always forget what SIFMA stands for. Whatever. They take all the treasuries and they put them into categories to show you where they are and who has them and how many are issued, etc. So this is the holders tab. And we see here in second quarter 2023, that's the latest statistics. Pension funds have $3.67 trillion, which is, it's an all-time high. Here, if we go back to 2012, it was 1.907 trillion. So it's about twice that now. That's going to be wiped out. We also have insurance companies that have another 412 billion, and then banks have the rest. Foreign and international has 7.7 trillion. So pension funds are going to be wiped out. If your pension fund puts a substantial amount of money into treasuries, which they all do by law or by financial regulation, they're going to be wiped out, and retirees are going to lose their nest eggs, and it's going to be a catastrophe for a lot of them. So people ask me, what should I do with my retirement funds? And like, well, if I take it out, I have to pay a penalty. But yeah, that's how they keep you in treasuries. They say, because if you take it out, you got to pay a penalty. So someone's like, well, then I'll just keep in treasuries, and that keeps their price inflated. But that's coming to an end, and it's going to come to an end very, very quickly, much more quickly than we saw in Weimar or any other hyperinflationary economy, because the world is digital now, and you can move an infinite amount of money derivatives in an infinitesimal amount of time. That's not this. It's going to be one day the dollar functions, the next day it doesn't. It's going to be one day. I don't know if it's going to be one day, but it's going to be like weeks and at most a month or two. It's not going to be more than that.
Yeah, and it's the other. Yeah. So let's see, Clive. What's your view on the pensions?
Yeah. So as Rafi said, when things come to an end, it can come very quickly, because the biggest enemy of the financial system itself is the mouse. Whether it be a rumor or a fact, or just people want to take their money out and move their money around, this could all be done at the speed of light now. In the past, you had to find your way to the bank and fill in some forms. It took weeks sometimes to move things. So, if things come to an end very quickly, it will be because the masses get hold of a story and they want to move their money very fast. As far as the pension funds are concerned, I took my pension fund out when I retired as a lump sum, because I did not want it to stay being invested and possibly going to zero. If it was good, it would have been invested, and to some extent in government bonds, because the pension funds have no choice in this matter. And I just felt that was a very bad investment. So I took it out and I put it into other things, and I'm quite happy that I've done that. So I think anybody who's thinking about retiring, my suggestion is, do your maths, but it might well be worth retiring early so you can get your hands on the pension fund and invest it in something other than what they're choosing to invest in. In other words, you take your destiny into your own hands. But I would only do that if you really know what you're doing financially. What you mustn't do is take your pension fund and put 100% of it into any one thing. You need to take it out and diversify it. But obviously things like property, equities, gold, all these kind of assets which hold their value over the long run are probably a wise diversification. What I wouldn't do is leave it in government bonds. I just don't think that makes any sense.
Yeah, and before we go to Andre, I wanted to say something in relation to what Rafi said, that a lot of people say, oh, if I take, liquidate my pension, I'm going to be, there's a penalty. But, and I'm not saying people should do this. It's just the way I would think, if I had a pension and I liquidated early, I don't know how it works exactly in the States. And there's a 20%, penalty fee. I think that's worth it, because if you leave it there, you're going to lose 100%. So 80% is better than 0%. So with that, Andre, what's your view on the pensions? Maybe, you know, having lived in Brazil, you being in Brazil, maybe you have even more of a perspective of how the pensions are going to be decimated.
Well, the pension funds have been weaponized so to create a captive demand for mispriced bonds on a global scale. If you think about the US corporate market, no different than the UK market, the pension managers, they have to do what they have to do, and no questions asked. Right now, just as an example of what I think is about to come, a lot of money from the pension funds on a monthly basis in the US, they get thrown out into the Apples, the Amazons, and there's a captive demand for those, but they have to be invested in bonds as well, no matter how expensive they might be. So this is going to play out, in my view, as the authorities on a global scale, they're trying to shore up the banking system. They call it like, let's have more credit restraints, let's make the system more safe. What they're really trying to do by that is by forcing banks to buy the public sector, to buy the bond market. So once they start rolling out these new rules for banks, capital requirements, risk requirements, what they're doing, in fact, is forcing banks to lend money to the governments, and there's not going to be money to the private sector. There's going to be a huge crowding out effect, and that's going to be bad for tax receipts, all sorts of things. So I think we're stepping into a twilight zone of sorts, because to Rafi's point, it's going to get ugly. To a certain point, they don't care about the pensioners. I tend to agree with you, Mario, because the situation is so mathematically damaged that it might have been questionable whether you would take a penalty to get your money out of your pension fund. But right now, it's a lot easier to make that decision, if you understand my point. So I don't know. Yeah, they're going to use all they have. They're going to crowd out they're going to crowd out the private sector. They're going to create new rules for the banks, so they have to hold a lot of bonds. We've seen this in emerging markets. In terms of losing the long end of the yield curve, if you stretch time long enough, sooner or later, all these developed economies are going to be funding their debt maturing within 30 days from now. That's what Brazil used to do back in the day. So they cannot issue long bonds. There's no demand for that because the level of financial repression is crystal clear. So they're going to issue T-bills at high rates. They're going to create, captive demand for bonds. Tax receipts are going to go down. The economy is going to shrink. And all of a sudden, you have a government that is way big, very large corporates that will maybe survive this. The economy in the doldrums, and inflation running amok, with the debt profile, the maturity debt profile becoming shorter and shorter. So we're headed to becoming a banana republic.
Yeah, and I think it's not just we're talking about the US bond market, but I want to bring something up here because I think this is really important. And it pertains more to Europe and Japan. And this is an article from November 6, 2020. So like 3 years ago, from Bloomberg. And it says world's negative yield debt pile has just hit a new record. So 17.05 trillion, according to Bloomberg Barclays Global Negative Yielding Debt Index. They even had an index for this. Now I think, as Clive said recently, there's no more negative yielding bonds, and it beat the record from 2019. And it says here almost 600 billion of bonds have seen their yields turn negative this week, meaning 26% of the world investment grade debt is now sub-zero. And before we go on to you guys, I just wanted to say that back then in 2018, 2017, people always used to ask me, how can people buy these bonds, that are negatively yielding? I said, well, it's because the more negative the yields become, the faster the price goes up. It's called convexity. It's like a speculative thing. And I said, I made videos saying this is the biggest bubble, the bond bubble. When this interest rates turn, is going to be a disaster. So maybe
Mary, I just on the negative yielding bonds, I was working in a bank at the time, a wealth manager, and people were asking me, how could you justify it? I wasn't doing it, but how could people justify buying these negative bonds? And what are you doing, Clive? And I said, well, actually, I'm investing in zero coupon perpetual bonds. And they said, zero coupon perpetual bonds? What's that? I said, cash. That's basically cash.
Yeah, that's right. Yeah. So no, I wanted to start with Francis. Could you explain to the viewers, because I think this 17 trillion, the fact that now it's all these bonds are positive yielding and running towards 4, 5, 6%. It's totally disastrous. It's a total. So maybe you could explain how you see it.
Yeah, the capital value, the valuation of those items, I'd love to see the number now. I wouldn't like to even guess. But they're obviously at the exceedingly low rates. I don't even know how it's going to function on the negative rates. But if you go from 0.5 to 1%, that's a doubling of the yield. I mean, this has devastating effects as a multiplier. So these things apply in a log scale type format, especially when you're getting to the very, very low levels. Even small movements are big movements. It's almost like a Richter scale. It's not proportionate. So, I mean, the amount of capital value that must have been destroyed already in those negative yielding bonds must be earth-shattering. And it doesn't shock me. I think your example that you gave, it was your story around a friend that put in 60,000 and has 38,000 left, and he's had umpteen years of growth, and that's where he's ending up, and he hasn't even drawn on it yet. So, I mean, I would expect similar mathematics, possibly even worse, on that number. So the whole concept, interest rates up, valuation down, seesaw. And the problem with the valuation contraction is that everybody sees this game coming, and the true bottom is naught. Just like everybody thought the bottom of rates was actually negative. It isn't. It was naught. They played with a bit of mathematics for a while, and they got away with it because of a lot of shenanigans and coordination. But you're very quickly getting caught out once you have a normalization of rates and you have the inflation, which was invariably going to come. So the key thing is we're going to see chronic asset valuation. We're going to see the three horsemen. There's a fourth as well, but the three horsemen is the FX volatility is going to get absolutely rampant and wild. I think, funnily enough, initially you get a dollar spike and then it crashes, and everything else breaks first for the base layer reasons that I think Andre was mentioning, and for some of the cases that Mr. Johnson has made out on his milkshake theory is quite correct, because the emerging nations that are weaker, that are borrowed in dollars, can't print dollars, etc., because of this part of the exponential period is requiring ever bigger interest rate payments. And of course, they don't generate enough sales to Americans to generate that income. Zimbabwe doesn't. In fact, I just came back from Zimbabwe, where I was riding 25% of all dollars that are paid. They say, please don't send us dollars, even though it's their currency that they use as well as Zimbabwean dollars. The bank immediately seizes 25% of any deposit of US dollars, and that is retained. It's almost like a dollar tax. And the reason they're doing that is because they lack dollars. So all those aspects further validate to me that you will actually initially get a dollar spike, but it won't be long lasting. And that is part of the whole collapse, all fall down. You're going to see pensions all lose entire value. So there's people here yet to go into pensions that have paid all their lives and are going to be left ward of state. And this is exactly what statism wants, because they then can say, well, we won't leave you high and dry. Have this CBDC, take any medical experimental this, make sure your hate speech on social media, yada yada, and give a bunch of criteria, and we'll fix your pension problem. But they are also going to try place the blame on us and say it's inflation, it's consumption. So there's going to be a lot of gaslighting with this whole experience. Look for it. The geopolitics will also be, and they'll also play the left versus the right. You voted them in. They'll make you complicit in it. Meanwhile, none of the left nor the right in America or anywhere else had any real control over the central banking cartel in terms of what they've done in a coordinated fashion on a global basis. So this is to bring us into, unfortunately, a Bolshevik communism world, where the statists will seize, and those that are holding the reins will be in power, and everybody else they were hoping are going to be rendered ward of state. So your whole game is to financially survive this and mentally maintain beyond the psyop and the gaslighting and the geopolitical fluff and warfare and every other thing under the sun, climate, whatever hysteria that they're going to generate as distractions. So it's going to be, unfortunately, exceedingly turbulent period for a number of reasons. The orchestrators need it to be that way for what is coming. You don't want everyone looking at where the earthquakes are going to come. You need to keep clapping, and it's like a child with a magic trick. You need to distract with the other hand. So this is what we're bracing for. So people haven't prepped enough. All of us, including myself, we simply haven't prepped enough on enough fronts for this. You don't even know how many different places the lightning bolts are going to strike. The whole goal is to keep you reeling so that you are in a state of shock and fear, because that way you switch the TV and you do what you're told. So you get ultimate compliance and everything else. You have to look at this as so much more than the financial collapse. You're looking at a social reengineering, a seizing of elitism by a cartel, and the subversion of everybody else. So, I mean, this has been planned for an extended period. There's no way that this is unpredictable. Simple people like me can get to the fact that we're coming to this eventuality. They have known and they have gamed, and they're in a state of high preparedness. And we'll see as they roll it out, much like you saw in the pre-little, what will almost look like a dry run, the March 2020 events. And that's my comment. It's devastating. It's devastating for everyone, particularly people reaching pension age that don't have skill sets, and they're going to be forced into ultimate compliance to a draconian totalitarian statism.
Yeah, and some people might be saying, "Oh, I don't have enough gold or silver, or I haven't done enough." But I think if you just do a little bit, you'd be better off than most. And my hope is that people are waking up and watching more stuff, more content like ours. And the other thing you said, they're going to try to divide you, distract you left, right. Here in the UK, all the problems, the left keeps saying, oh, the conservatives are, 13 years of mismanagement, Brexit. But the same thing happened under Labour. It's all about the debt, and they're going to try to tell you otherwise. So, Rafi, what's your view on that?
On what specifically?
Sorry, are we finished? Was I asking about the pensions, wasn't I? So
I think Mario, I think you were talking about trillions of dollars at negative rates.
Oh yeah, Rafi. So yeah, if you could, maybe Rafi, you've got an interesting analogy so people can understand how significant it is that 17 trillion in bonds have gone from being negative yielding to high yield.
Well, it depends on who owns these bonds. I mean, the two biggest institutions that hold these bonds are central banks and regular banks. So if central banks are holding these bonds and the bonds have fallen in value that precipitously, then the central banks hold the bonds on one side of their balance sheet. The other side of the balance sheet is the currency itself. So it's really, if the bonds go down, the currency itself goes down. So we should be seeing higher and higher interest rates and lower purchasing power for currencies. That's what we're going to see into the hyperinflation. But one point where I disagree with with Francis here, and maybe even Clive too, but this has come up before. I just want to make my position clear. I don't think that there's going to be any way that they can turn on CBDC or turn us into a global Bolshevik prison. Because in order to do that, you need to fund it. And once their currencies fall, they have no funding, and then you don't have a Bolshevik control of anything. You just have chaos where you have pockets of maybe some organization in like rural areas where the local lord has some amount of gold and silver where he can hire workers to do whatever he needs to do in his local area. And you have just a complete breakdown of all power structures. That's what I see. I don't see the government any governments having power to force Bolshevism or CBDC on anyone, because where would the money come from to do that? Once their currencies fall, that's it. They have nothing left.
Well, that's good to have different opinions. I personally think, I mean,
Either way, it's bleak. It just
Yeah,
depends
it makes
on how
sense.
you exactly see it coming.
Makes sense what you said, and to us, it makes sense. But I think people will be so scared and so destitute that they will accept something, and especially if they blame this not on the debt and the fact that they had 50 years of fiat currency, and maybe people accept it. I mean, like you said, whatever happens is going to be bad. So. Let's start wrapping up because we've been here for over an hour. So we'll start with Clive. Clive, could you maybe tell us if you think there's a way out of this debt predicament, and then also the way to deal with it, not just financially but also mentally?
The way out of it, there's more than one way out of it, but at the end of the day, it will involve a loss of value for those who hold bonds and cash. And so one way out is to replace the currency effectively, or replace the central bank with a new central bank. Another way is to impose on people in a certain way where they have no choice, but their assets are sequestered to be invested in the government, basically, so the government can pay its bills. I think the central bank digital currency could be a route to changing the currency. So to start with, you have one-to-one convertibility of your existing dollars to central bank digital currency dollars, and then they close the window and you can't actually move your money across from left to right anymore. And you suddenly found that the only thing you deal with is the money of CBDC, but all the money which is left behind in the old currency, the defunct currency, basically it's a kind of debt forgiveness globally for the governments especially, but it's also a wealth destruction event, which means an awful lot of people who are wealthy and own that debt are going to find themselves suddenly poorer. Now, one might well argue that the people in power who are the wealthy are not going to let that happen, but it's what's happened over and over again throughout history as currencies have failed. Those who have the money have basically found themselves holding a worthless asset. And I think that could repeat itself at some point in the future. But the way you protect yourself at the end of the day is not to have too much exposed to the government, not to have too much exposed to fiat type assets. And bearing in mind the book that you were talking about on one of your recent videos, Mario, which is the Great Taking, which I've read as well, which is one where you discover that the assets you have in safe custody, you may not be able to lay your hands on them. I urge everybody to have some assets they can lay their hands on, and that probably means get it outside the system. You can have it at home, or your home itself could be the asset that people can't lay their hands on. Build a loft extension or a garden shed. If you want to deploy a little bit of money, don't keep it in the bank. Is what I say.
Yeah, I agree with you, and I don't think there's a way out. It's just, maths was not my top subject in school, but you don't have to be a rocket science to realize that the debt is not sustainable, and that's what I find interesting, is that a lot of people on Wall Street and economists, they kind of ignore the debt. They just look at the numbers and tech. I know technical analysis is important, but they don't look under the hood or the bonnet, as the English say. And And I think that's why so many people are going to get hurt. So we'll go to Andre now and his view on whether he thinks there's a way out.
I'm a little more optimistic. By the way, I do agree with Rafi. Uh, but the only one caveat I would add is that for sure they're going to try. And I agree that they won't succeed. But from point A to point B, there's going to be a lot of turbulence, a lot of, problems. That being said, why am I a little more optimistic? Because of BRICS Plus. You see, if the United States were to grow a brain, they have resources, they have commodities, they have energy, they have oil. They could just stop this madness and cut spending and restore their system. But like I said, Europe and Japan do not have that luxury, and their currencies, they lay on the base layer of the US Treasury market. So I see a not too distant future where Europe is going to have to bail out, and Japan is going to have to bail out under the guise of the United States. Because whatever happens, they won't have money that is worth anything to survive. And that being said, I've read, look, about the central bank digital currencies, to Clive's point. I hope you're aware, Clive, that they have a couple of layers with these CBDCs. The elites have more freedom. Their CBDCs have more freedom than the populace. It's an open source technology that has been exposed, that big corporations, they will have a favorable treatment as to how they can spend their money. But going back to my point, I think for a matter of survival, it is being rumored that Europe will end up with no choice but to revalue its collective gold reserves. That is going to cause severe debasement on the euro, but that would basically restore their leverage and allow them to afford food and energy. I don't know exactly how this could play out. Maybe they will make the people poor, keep them under a CBDC, and have another layer of euro backed by gold that they can use to buy what they need to survive, basically food, energy, and some other commodities. Japan, same thing. They're going to have to do something. I think Japan is in a little more trouble because they have too much leverage. What I think Japan is going to do, I think what Japan's game plan is, which is not going to work out too well, they're going to have to sell their stash of treasuries. They have $1 billion in US treasuries to afford gasoline, to afford oil, and all sorts of imports that they need to keep the game going. But what Japan thinks is that they can survive long enough until the Fed starts to ease. But the problem is the Fed is in a fiscal mess. You know, when the Fed starts to ease, that's when hell is going to break loose, as opposed to the party beginning, as we used to see in previous cycles. I don't know what's going to happen, but I know the Fed is going to have to ease, but it's not going to be the outcome that we all expect.
Okay.
So what I'm trying to say is, maybe this might force BRICS Plus, transacting in gold might force those, certainly Europe, but maybe other countries like Japan and even the US to readopt some kind of a gold standard, not because they would like to, but because they tried the impossible. What Rafi said, they tried to go into some kind of Bolshevik global one government sort of thing. This doesn't work out, so let's go with gold. I mean, that's basically my 2 cents.
All right. There's a super chat question here from Vince Grant. He says, and I'll let Rafi answer this one. Yeah, but the central bankers own more silver and gold than anyone else, so they will dictate the next currency. I don't agree with that. What's your view on that, Rafi? And then maybe you could end telling us if you think there's a way out. I'm sure you don't think there is.
No, there's no way out. There's only a way through. It's like mourning, right? There's no way to bring back your dead, but you can get through it and move on. So that's what we got to do. The only way out is through. Is that the saying? So first of all, factually, central banks own zero silver. They don't own any silver at all. And second of all, yeah, there's been some buying lately, but it doesn't matter because the amount of gold that central banks have now is about the same that they had in 1950. It hasn't really changed much. They sold from about 1968 to 2000 almost year after year after year without very little exceptions in those decades. They just kept selling. So they have the same now that they had back then, but the difference is they have like a whole much more currency units. So it doesn't really matter. And also, even if they had a lot of gold, which they don't, it doesn't matter because it doesn't matter who. It's not that they have gold that gives them power; it's that they have the ability to steal from us through the process of inflation that gives them power, because that gives them a much bigger pot to steal from. Once they only have gold, then they spend gold, and then that's it. And then other people have the gold, and then they have the power. I mean, so let them have gold, let them spend it. It doesn't really matter. I just want them to not have the ability to inflate anymore, which is let them have whatever gold they want, as long as they just, if they want something, they have to spend it out, and they don't have it anymore. And I think I answered all those questions.
Yeah.
So, yeah, there's no way out.
All right, and so we'll end with Francis and his view on whether, magically maybe we'll get some aliens and they'll pay off all the debt.
I think Rafi's. We're definitely going through this. I've referred to this as the Shawshank Redemption. He was a bit more graceful. I referred to it as the shit pipe that you're going to go through, and boy, it's going to smell. I remember the moment where he's in the river with his hands in the air in the rain. That was some journey, and that's to get any form. The only difference for me is that there's not a true freedom on the other side. I am probably the most bleak of all the speakers here in terms of what's out. In other words, I think this is orchestrated and well known and well rehearsed. I don't think it's random. I don't think we've just stumbled in it. I would wish for the scenario Rafi described, where there would be no leadership and we all just localized. I would seize mayorship on all my local community and get organized and be left to our own devices. I don't for a minute think that. I think we're going to see a much stronger status grab of control. There'll be lockdowns. There'll be rioting. So they'll have a justification for keep everyone indoors and various other things. So I think actually we're going to see a higher exertion of totalitarianism. I would love to be wrong. So I set a very bleak bar. And if I'm wrong on that, that just means everything's a little bit better than I laid out. So the whole game of setting a bleak bar is not being a nihilist and a self-flagellator. It's about making sure that you've prepared for every possible eventuality. And in the event that they undershoot on their degree of totalitarianism, then, hey, you did something without necessary. Now you're self-reliant on food. Isn't that a terrible thing? And all of those various aspects. So my undertaking of this is that people don't realize the nature of the test. It's going to be psychological. There was a massive spike in male suicide particularly, but suicides generally, and men are those that fall under the bus. I was just with another friend who recounted someone who planned over 6 months his suicide because he lost all his wealth. And in South Africa, if you've had the policy for more 2 years, they pay out just so that his wife and kids could get the money. So this is really important. It's not just about money. It's about recognizing that you're about to run an obstacle course. Brace yourself, expect to get muddy, expect to get dirty, and expect to struggle in parts. If you go in with that mindset, you will win the game. So rather than being the negative guy, I am bracing myself for being put in a ring and getting battered, like the proverbial shit pipe I just described from the Shawshank Redemption. If you are already in that state, you are far better. If you're training to fight, you fight easy. If you're saying there's no fight, be positive, and you end up in a fight, you get absolutely battered. It's a shock and you get broken by the process. So I would argue that the mental framing for preparation is the right mental framing, even if it's excessively pessimistic. So with that said, you need physical assets, you need self-reliance. So everything I'm looking at property-wise here is borehole water and is 100% solar proof. So I am the absolute need for government, it must be largely removed, large tracts of land, and I have a massive desert with 40,000 hectare semi-desert farms that it would be a nightmare for a government to try keep me under control if I'm out there. So, even with drones, they wouldn't be able to watch me. So I just want to be away from, so ruralize, ideally, self-reliance, food. You don't have to become a farmer. I've never farmed in my life before. Maybe it's a good time to make a strategic investment, something Chris McIntosh and I have discussed, and he's very interesting. Just buy a stake in it and say, hey, pay me some eggs and sheep, and then the rest, I'll buy a house, I'll build a house in the corner, and it'll be my bolt hole or my bug out bag plan. So I think those things need to be done. It's not just a financial event. There's the social unrest and the geopolitical events that are going to be tied into this mix are going to be immense, because they're going to have to serve as distractions. You're going to have a lot of people running around without access. There could be grid downs, there'll be internet downs and mobile downs. So while I will say buy the statist tokens, and all the ones in the top 10 are playing a role in the surveillance finance era, whether it's XRP or Ethereum, they're all captured, they've got government corruption, and that's good because they'll go up, because all the criminals are there, and the ones that are the criminal entities, much like your stock market, which are all part of the surveillance finance system, Facebook, Google, Microsoft, the military industrial complexes, servers, basically all those businesses that have flown are the statist businesses. And the tokens that will fly are those that are going to be bringing the control structure on you. So at least make the money and be a rich slave, rather than thinking it'll never happen and they'll fail. I've just followed the route of Cecil John Rhodes. He never failed. They cornered the diamond market in South Africa, and then they grabbed the gold market. All of history shows immense power, immense planning. This guy was bankrolled from the city of London and Amsterdam and everything. He bought everything up. He wrote the biggest check in the world to Barney Bernardo. Every semblance of history that I study shows that you are fighting against a far more organized octopus and network of capability than you even realize. To underestimate the extremity and the capability of these people, including the fact that they could be, have these copies of what we're discussing right now. They have game theory for gold bugs. I've even gone so far as to say, if you're a gold purchaser, you're going to be pushed into probably registering the fact of how much you own. You need dark gold. You mustn't register everything if you're known to have bought. All sorts of things will likely come out. That will be figments of control, where they seem to open and want to know your wealth. NFTs and tokenizations, as per BlackRock's CEO, is the thing he's most excited about. It's less about the Bitcoin and the tokenization, because he says you leave governments. What they actually want is the transnationalization that'll give them. They will buy your token that is the representative token of your property, and they will own it. You'll be forced to declare. This has already been discussed. Chicago professors have done it. It's going to run on the Ethereum network. People have put in plans way into the future on a lot of things, including the next pandemic plan that's being signed off by World Health Organization. Lots of things are going on that people aren't even seeing that are going to affect you. This is a major transnational demon that you're fighting. I have no other way to do it. Get rural, buy space, and have reliable community friends around you, and get physical. Digital is not your friend, although I would advise, from a practical point of view, having some of the top cryptos. We handle that in our community. Those are the things, and treat it as a psyop. The game is to survive this game. You've got to gamify life. You've got to just pretend you're that kid on the arcade machine. There's going to be a hell of a thing coming. There's going to be people lost along the way. I'm going to try save as many of the people that are precious to me. I'm going to talk and convince. Don't waste time on those that aren't ready, and gamify the entire experience and walk through that shit pipe, crawl through it, get out to the other side, and you're going to be one of, I think, a lot smaller percent. I don't think everybody makes it. I really don't. Not financially, and in many cases, not even potentially physically. And this is a different world in 20 years time that we'll be living in. And if you're still around, you've done great, and that's the goal. And then in the meantime, live life to the fullest. Give yourself a lease on life that every single month is another great gift. Do something beautiful, love, dance. If you're the kind of guy that has a beer, have a beer. Be healthy, fit, because you're going to need to have your wits about you. And that is the holistic approach that I'm taking to what is not just going to be a financial event. That's my takeout, and I'm focused on that. This is Reset. We are watching the movie happen. And that everyone asks, when's Reset happening? It is happening. It's not a single day. It's not a single moment. It's not a straw that breaks the camel's back. It's the whole overload process that we're now in that is coming to the fruition. And these cracks, these rivets that are popping on the submarine are as a result of everything that was put in the trajectory all the way. There is absolutely no way you get out of it. The snowball is halfway down the hill. It's 20 times the size that it was started. The avalanche is coming with it. There is no freeze button. The village is getting hit. Now decide where you're going to be in that village, how far away, how prepped you're going to be. And that's the game, and survival is winning.
Well said. And I think you're right on the psychological part, because it is a psyop. They want to make you scared. They want to, like, I think fear is like a bad emotion because it stops you from living life. So yeah, I think that's great advice to, have a community, be it like us or even, where you live locally, and help each other, and try to be as self-reliant as possible, and have assets outside the system, have a little bit in the system, so with that, I'm gonna thank all of you guys for coming on this live stream, and I wish you all a great week.
Goodbye, and
Bye,
lovely to
everybody.
meet all the other guys. Godspeed.
Yeah,
Bye, everyone.
thank you, guys.